With the strong S&P 500 V-shaped recovery observed recently, let's explore the following question. Is the market's optimism sustainable? So S&P 500 has been a strong year. It's up 18% year to date. It has recently experienced a V-shaped recovery for the July dip. And it has actually recovered 8% from the bottom to the top. The bottom happened on August 5th. It's showing us that the overall market sentiment is very optimistic. The Wall Street 2024 year-end target can be seen on this chart versus the current S&P 500 level on this blue bar here. Actually, the current S&P 500 level is a little bit higher than this now. It's at 55.97. So this chart is telling us that we need to be aware that the current S&P 500 level is a lot higher than the average Wall Street year-end target, because every single red bar here represents an institution's year-end target for S&P 500 observed at the end of last year, December 2023. And this yellow bar here, 48.61, is the average Wall Street year-end target. So we're a lot higher than that. It seems like the retail investors right now are a lot more optimistic than the Wall Street. This chart shows you the NASDAQ 100 with the ticker symbol NDX. It's 10-year monthly performance and the 10-year average performance. Every column shows you a month of the year, right? And then every row shows you a year number, and that's that year's month performance. And on the top row, it shows you the 10-year average of every single month. So that's like a seasonality data of NASDAQ 100. And one thing to note is September, on average, is doing pretty bad. On average, in the past 10 years, it's down 2.77%. Okay, so what's the takeaway gonna be is that we're heading into September. It's August 26th today. Sorry, August 21st. So traders need to be very aware of this September seasonality problem with NASDAQ 100. But of course, if you're a long-term investor, this doesn't, or even a medium-term investor, this doesn't really apply to you. These charts come from the latest Goldman Sachs report. It's showing that the prime broker trading flow for the U.S. equity as of August 16th. So prime broker trading represent the trading done by the institutional investors at Goldman Sachs. In the chart, the black line shows the net flow, so the sum of long and short flows. Okay, the blue one shows the long flow, the red one shows the short flow. Okay, and it's a percentage, right? It's captured in percentage since January 2024, so since the beginning of this year. So year to date 2024, the net flow turned negative, right, above zero in recent months, about mid-June. Okay, so currently the net flow over here is about minus 15 since the beginning of 2024. Again, this is prime broker flow, meaning the institutional trader. This includes the smart money. The chart on the right shows the prime broker net flow by U.S. product. We have the black line showing the single stocks, of the blue line showing macro products such as index or ETFs, so basket of stocks. And as we can see, apparently the single stocks were sold a lot more than the macro products since the January of 2024. And in the past week, or in the week ending in the August 16th, the four most sold single stocks were in the industrial, consumer discretionary, information technology, and financial sectors. Okay, so this data here is showing us that investors need to be aware that the institutional investors who have a lot more research, who have a lot more access to data, who have a lot more access to resources, they're increasingly positioning themselves for a potential market decline. They're getting more defensive here. Okay, and that's why some of the Wall Street people are calling the current situation a pain trade, right? Because it's because more and more institutional investors, it gets more defensive, and the market continue to go up. It's causing a lot of pain for those people, right? So that's why currently we're in a pain trade scenario. This chart shows you the SPY, or the most popular, most traded, invested S&P 500 index ETF, and it's trading volume at the bottom here in purple. So the price and the volume, right? As the price go down, the volume went up, and right now as the price go up, the volume actually went down. Okay, so this is what the chart is showing you. The volume and the price is showing opposite directions. It's an indication of weakness. Okay, it's showing that it's showing that less market participants are driving this move. And this situation is what we call a cautious optimism that retail investors needs to be aware of this, okay, of this weakness, okay. So this is all I want to share with you today. Please answer the following question in the comment section below. Do you think the current market optimism is sustainable? And do you think institutional investors' more defensive stance is justified? Thank you very much. Please don't forget to like and subscribe.